All right. Well, welcome to Finance 444, Week 1. I thought we might not have as many participating tonight since it's Monday night of the very first week of the mod. A lot of people haven't even logged in for the first time yet, and we're already teaching a session. So hopefully you'll have a chance to review the recorded session. I will make the sessions hopefully go by quickly and painlessly and actually be informative and hopefully a little bit entertaining. I do try to go fairly fast through them so that I can pack as much in as I possibly can. We rarely get through all the slides that are provided for the chapters and material that the book chapters that we're covering, but the most important thing is we want to make sure that you're ready for the coursework for the week. So we'll go over the assignment, the assessment, the discussion board every single week within the session. So one of the things that we'll do is, for example, this week's assessment, it's the test for this week is a 50-point 10-question test. At the end of class, and we'll do this every single week, at the end of this session, we'll go over every single one of the topics that you'll need to know for the test to be successful. Won't give you answers, but we'll give you the topics that you need to know so that as you study chapters 12 and 13 this week, you can have a more focused study and know what you need to know before you get to the test. Okay? And then as far as discussion boards are concerned, fairly straightforward. I see that some of you have already started to participate. Appreciate that. Of course, the expectation there is that we'll have 3 posts, right? A main post and then 2 responses. The expectation is that the main post will be in by Wednesday at midnight, and that it'll be a substantive post of 2 to 3 paragraphs with at least 1 reference. And then the other 2 posts will be completed by Saturday, and that's all if you want full credit, of course. And this brings up a different topic for expectations in a course like this. I do accept late work all the way up until the last week of the mod. I do accept work right up until midnight on Saturday, the last week of the mod. However, if assignments and assessments and discussion boards aren't turned on time, they won't achieve full points, which should be understandable and consistent with other professors that you've had. So just keep that in mind. I do accept late work, however, it won't be awarded full credit. A couple other things. We always get the grading done by Tuesday at noon. I think the school policy is Wednesday at noon. I do grade, however, things together. I don't usually grade throughout the week, and that just allows me to be a little bit more consistent with how I grade from one person to the next. So I usually wait to do grading, and I usually grade it all between Monday night and Tuesday morning. Okay, so if you have any questions on that, let me know. Best way to communicate with me is within the syllabus under course information, and then of course instructor information. I do, you're willing, and if you're able, you can call me, you can text me, but the very best way to get in touch and to communicate and then get a response within 24 hours is via email. And I strongly suggest that you use email if you ever get caught or have any questions on what you should do with some of the coursework. So that is that. A couple of things as far as overall expectations for the course. Shouldn't be inconsistent with other courses that you've taken, but one of the things I'll just remind you is that the checkpoints, the daily checkpoints, are worth over a half a letter grade of your overall grade in the class. And so although they're only 5 points apiece, it's something that I would strongly suggest that you complete. Actually, the full points available are over a letter grade of your score at the end of the class. The extra credit associated with discussion boards, checkpoints, is over a half a letter grade. So I just strongly suggest that you be consistent with the checkpoints so that you can get all that extra credit that's available and so that you can get the full points that's available as well. Hello, Frida. I think I've had you in a class before. Welcome back. We're just going over some basic expectations, just that quick review that we do in week 1 of every class to make sure that the expectations are consistent, and also just a reminder on a lot of the expectations. Here in a sec, we'll get to some slides from chapter 12 and 13. Course material for this week is chapters 12 and 13 of the book. We bounce around a little bit. We're not going in order necessarily, and so just make sure and keep on top of where we're at and what the readings and tools are suggesting that you do. If you do me a quick favor, Frida, I don't know that you can do this, but if you can, will you log into the course and just see if the assessment is available when you click on it? So don't go in to start it, but just click on it to just see the overview of it. For some reason, the link when I was clicking on it earlier was not working. And so I've had to go a different way to get access to it so that I can go over it tonight. So I just am anxious to check that. I don't know, Frida, if you can do that during our class at some point. Take a minute and go check the assessment. Don't get into it. Like I said, don't start it. Just get into it before you start it and just make sure it's there and ready to go. And if it's not, I'll find out what's going on there and we'll get that fixed tonight or tomorrow. So as we mentioned earlier, expectations for the course fairly consistent. Make sure you get the checkpoints. Make sure you get that half a letter grade that's available for extra credit within the checkpoints. Make sure you get your discussion boards done each week for full credit there. One of the easiest ways to get points in a class like this is discussion boards. And I think it's one of the more rewarding aspects of a course like this if you really put in effort to it. If you're doing a couple quick responses before Saturday at midnight and barely getting the initial post in by Wednesday at midnight, and not really reading anybody else's posts, is really getting into the discussion, then sometimes it won't be very fulfilling, these discussion boards. It'll just be jumping through hoops and having to accomplish something for the course, and there's nothing wrong with that. But I promise you, if you'll put a little bit of effort into it, and I'm just speaking from experience, my own experience, having taken multiple online courses myself, that you can get quite a bit from those discussions if you'll do that. Hey, thank you very much, Frida, for checking that. Glad to hear it. So this week's assessment, Frida, and I mentioned this earlier, just 50 points, only 10 problems, and we'll go over all 10 topics when we get to the end of the course tonight. Probably just spend the last few minutes is all, because it's such a small test, pretty straightforward test. It shouldn't take us too long to get through those topics. All right, so just trying to think of other things that we might need to look at or address before we start. We do have a learning coach for this class. It's Lindsay Haas. Lindsay's been, a learning coach or a TA or whatever you want to call somebody that's supported the finance classes that I've taught for probably 2 years. And so she's got a lot of experience helping out with finance classes. She's busy though, so one of these things where if you get stuck up on something, and communicate one-on-one with her, she usually can set something up, but you'll have the most success if you contact her early in the week instead of waiting till Saturday. Also, I'll be posting her information and her weekly regular schedule where she'll do a tutoring session, basically a scheduled tutoring session for anybody who would like to show up. Okay, so I'll have her information up in a little bit. Other issues. So just quick housekeeping issue with all classes, and this should be consistent across any class that you take. Basically, the grading breaks down as like this. You probably won't pass the class if you don't get all your coursework done. That's the easiest way to fail a class, is to not turn everything in. If you turn everything in, you'll most likely pass. Okay, there are very few exceptions to that. So if you'll just put in some decent effort and turn everything in late or on time or otherwise, you'll probably pass the class. If you're looking to get an A from the class, we just need you to follow expectations, follow instructions, turn everything in, and turn it all in on time. That might sound like a high bar. It really isn't that difficult. These classes do move fast, though, and so you have to be very disciplined about staying on top of all the coursework to get things in on time. If you turn everything in on time, have sufficient effort, it looks like you're really efforting the class, and still end up in week 4 with a grade that you don't expect or didn't want from the class, meaning it's lower than what you were expecting, then if you'll just email me, we can maybe consider other options for you to improve your score. One last thing, and Frida, you might remember this from previous classes, I do allow for resubmissions on assignments. So if you submit an assignment and it doesn't go well, I'll give you a score, I'll give you some feedback in the comments, and I'll encourage you to resubmit for additional points. So that might be an inconsistent thing with other classes that you've taken. Everything else that you've heard to this point as far as expectations should be consistent with other classes that you've taken. But I know that there are some professors who don't allow resubmissions on assignments. I'm happy to allow that, and if you'll effort it, I'll award some extra points. So just keep that in mind. But I'll also remind you as you turn things in, if your score isn't full, other than the late discount, if you just get a discount for turning things in late. But if you don't get full points on something, I'll usually suggest what it is that you can do to improve it, and then encourage you to resubmit the assignment for those additional points. Okay? All right, so that's some basics about expectations for the course. We will be holding these sessions on Monday night at 8, just because that's an easy way to get it early in the week. I realize that it might be a hard night for some of you, and that's perfectly fine. I don't expect you to always be in the live sessions, although I have found in past classes that it does help some folks, if they can make it, to be in the live session, to ask the questions, to interact, and to feel comfortable and confident coming into the week early, that you're ready for all the coursework. All right, Frida, any questions about any of those expectations? Most of it should be a review. Thank you for joining us tonight, by the way. Appreciate it. I really do. I'm very appreciative of anybody who will show up to the live sessions. You get picked on a little bit, right, Frida? But we won't make it too difficult, and I promise I won't put you on the spot too bad. Every once in a while, I'll try to ask a question or two just to make sure that you're still there, but even if you're not, that's okay. So anyway, so this course, Finance 444, is really about investments. And it's a great course for me because personally and career-wise, it's been something I've been very interested in my entire life. I was taking the Wall Street Journal at a very young age. I invested in mutual funds before I graduated high school. And that was back when you couldn't do it online. I had to actually have an account that I mailed off for and then did it by phone. Those are the olden days, just about 20 years ago. But anyway, very interested in investments from a very early point. And then for the last 15 years, I've been a financial advisor helping clients, customers, as my day job, helping customers and clients to do investments, to help them with investments. And so anyway, this is what I'm in all day long, every day. I enjoy it. I'm excited about it. Even when I'm not doing it for my work, I'm looking at it, I'm reading about it. I've got CNBC up on my phone and my computer at home all the time to check how things are going, what the latest news is, and just something that I really have fun with. So if I get excited about some of these topics, you'll know why. But hopefully it makes it a little bit more entertaining that this is something that I can apply most any day to what I've done that day for my work and what I've done that week. And so we're going to talk tonight about a couple different chapters, 12 and 13, as I've already mentioned. We're going to talk about investing in stocks and bonds, and then the next chapter talks about investing in mutual funds, and we should add exchange traded funds, or ETFs, which is a very popular up-and-coming product classification over the past 10 years. So the growth in exchange traded funds, or ETFs, so ETF is an acronym for exchange traded funds, but the growth within the ETF marketplace has been much higher or much more rapid than it has been within mutual fund stocks, individual stocks, or bonds over the past 10 years. So ETFs are becoming more and more popular because of some different pros that they have, some different advantages that they have. And they're a relatively newer product. However, they've been around now for about 10 to 15 years. Okay, so we'll talk a little bit about ETFs. This first chapter talks more about just the basics of stocks and bonds, and then we'll talk a little bit about, like I say, ETFs and mutual funds if we get to it in chapter 13. So just as a reminder, Frida, and for all those who are listening to this later, let me just remind you what stocks and bonds are. I mean, we throw around those terms a lot, and sometimes I find that if I ask, what is a stock or what is a bond, people have a hard time describing or defining what it is that a stock is and what it is that a bond is. And so let's take just a second. Frida, maybe you already know this, so sorry for the review if you're already on top of this. But for the sake of the rest of the class, maybe potentially, let's visit about it real quick. Stocks, when you have stock, what you have is partial ownership in a company. So if I own Apple stock, I'm a part owner, and this may sound kind of hokey, but I'm actually a part owner of Apple, the company. And there used to be some really fun commercials years ago that an online broker, I think it was E-Trade, used to have, where it would show different people saying, I own Facebook, or I own whatever company, and Nike or whatever. And it was just a advertisement to promote online investing, right? So online brokerage investing into stocks. But it was just kind of fun because all these people were saying, I own Microsoft, I own, whatever. And at first you're like, oh, maybe that's the owner, but the majority owner. But reality is it was just individuals who had bought some stock. Now, as an individual owner or trader of stocks, we have partial ownership in that company, but our partial ownership might be so small, and usually is so small, that it doesn't give us a lot of power or control. However, if you're somebody like Warren Buffett or somebody like Bill Gates that invests billions of dollars into a company, that does give you considerable control over the company when you have that kind of ownership. For most of us as individual retail investors, we're not going to ever have enough ownership of a company to really dictate the future of that company. We're just trying to participate as an owner of the company in the upside potential of that company. So if I buy Apple stock, it's not because I think that if I buy Apple stock, I'm going to somehow have control over their future and what they do. What I'm buying Apple stock for is for the right to participate in the upside potential of Apple as a company. So as Apple grows, right, and as Apple succeeds in the future, I would benefit by owning that stock. Okay? So stock, equity, and shareholder, right? I can be a shareholder, a stockholder, and an equity holder, and all three of those mean the same thing. They mean that I have an equity ownership position or an ownership position in that particular company, albeit maybe very small. I have an equity ownership position. Okay, so that's a stock. When it comes to a bond, we're just talking about debt. Okay, we're talking about debt of a company, of a government, of any kind of entity. That debt is referred to as bonds. Now, we're not talking about the debt that they go to a bank and get, right? We're talking about the debt that they go out and get from individual investors and institutions. So let's say you're Walmart, right? And you want to go build 100 new Walmarts in China, and each new Walmart's going to cost $100 million, okay, to completely build, to hire everybody, to train everybody, to do everything associated with building a brand new super Walmart. And instead of, spending billions of dollars on these 100 new locations, you go out into the marketplace and you raise money by encouraging investors to enter into a promissory agreement or a promissory note with you as a company. So Walmart goes out and says, okay, we're going to pay you guys 4% per year for the next 20 years, and then we'll give you all your money back after 20 years if you're willing to invest in our bonds, basically. Okay, and so there's some kind of agreement, like a debt agreement, and we're going to get some kind of interest rate over time, and then we'll get all the money back in the end. That's what a bond is, and you can have government bonds, you can have state municipal bonds, you can have corporate bonds. So all these different entities issue debt, and then they promise to pay back over time with interest. Okay? Any questions, Frida, on what the difference is between stocks and bonds? What basically they are? We don't need to go into a lot of detail, but just want to give you some basic background on those two. Okay, so maybe you already were right on top of that. Have you ever invested, Frida, in stocks or bonds, if you're willing to share? Oh, nice. So you're ahead of the game. So good. If you feel brave at some point during the class tonight, share with us what you invested in and what your experience was. If you don't want to share, that's just fine. But we'll keep going. If you want to let us know about that, that's great. Okay, so chapter 12. There's a few different things that we want to look at. One of the things that is significant about investing in bonds or stocks or anything is that anything that we invest in has risks associated with it, right? There's some form of risk. And in fact, most investments, bonds, stocks, mutual funds, have multiple risk factors associated with them. It's one of the reasons that when you get what's called a prospectus in the mail when you invest in a mutual fund, or a prospectus based on an ETF or a stock that you invest in, sometimes those prospecti are 60 pages long, and 40 pages of them are small print about the risks associated with the investment that you just invested in. So sometimes that prospectus will scare my clients when they get them because they're so long and they talk about so many different risks that they scare my clients from even wanting to invest, even if it's a great investment. So it's just a legal disclosure issue that they have to do with different types of investments. They have to disclose all the different types of risk. Most people don't read those. And in addition to that, most people don't really understand the risks associated with their investments. So most people, if we asked them on the street, hey, what do you think the risks of investing in stocks are? Most people would just say, well, I could lose all my money, right? And that's a pretty substantial risk, and the one that scares us the most, right? The risk of default. But there's all kinds of other types of risks associated with investing in any kind of investment product, and it makes sense to review through them and make sure that we understand them. So let me see if the slides actually give us some detail. they don't. So I'll go through each one just briefly. Frida, MasterCard, that's actually a great stock. Did very well. I hope you held on to it for a while. Most stocks, right after they go public, that first day they'll go way up, and then sometimes they come back down after that. And then it takes some time to recover and come back up and do well again. I don't know if that was your experience with MasterCard, but that's a common scenario with an initial public offering, an IPO. But that's cool. You invested in MasterCard, and then you've had savings bonds, the double E type, that pay interest for 30 years, okay? But after 30 years, they don't pay anymore, right? And these were probably the type of bonds that you paid half the face value for. So if it's like a $100 certificate bond, then you pay $50 for it. And you usually have to wait, 12, 13 years to get your face value, and then you can continue to get interest for all 30 years, which is kind of a cool thing for double E bonds. The other nice thing about double E bonds is that right now, if you have double E bonds from years back, they pay a lot more interest than like a savings account or new double E bonds do now, which is great because it's hard to get good interest anymore, and so those double E's pay us a little bit more if you've had them for a while. So remind me, did MasterCard IPO right before the market crashed? Wow, I have a horrible memory because I was thinking MasterCard was post 2008, like it was in like 2010 or 11 or something like that. So you wrote it down through the crash. Did you end up just hanging on to it, or did you end up selling it and getting out? Good. So have you recovered and done better than? Have you made some money on it yet? Oh, you let it recover and then you sold it. Good. Well, as long as you don't tell me that you lost, half your money and then you sold it, that's the thing that really scares people about the stock market is they hear these horror stories about people who wait for their investment to go down and then they sell, right, Frida? So Frida, it sounds like you're a step ahead of the game, right? We know that we're supposed to sell high and buy low, but the challenge is our emotions sometimes get in the way, right? And we end up doing the exact opposite of what we should do. We end up selling when things are really bad and we panic, our emotions get the best of us. And then when things get high, we decide, hey, investing in the market's a good idea again because everybody's making money. And we follow everybody in right at the top, and then things crash down on us and we sell again. So statistically speaking, if you look at history, Freedom, most people as individual investors do the opposite of what you did. They panic when things get bad, they sell out, and when things get good, they get back in, and that's about the worst thing you can do, right? Because you'll never make money if you're buying high and selling low. In fact, you'll lose quite a bit of money that way. And we all, we can chuckle about it, but that's actually, we know based on statistics, based on the numbers, the flows that come into investing when things are good and the flows that go out of investing when things are bad, we can actually point to that and say, we know for a fact that the average investor is making the wrong decisions when it comes to investing, getting out when it's bad and getting in when it's good. So, okay, so we were talking about the risks of investing. And by the way, Frida, thanks for sharing. That's really cool that you've had the experiences that you did with different kinds of investing. So you've had both bonds and stocks. And of course, we'll be talking a little bit about each. So different risks associated with investing. There can be specific business risk, right? A business can be underfunded. It can have fraud. WorldCom, Enron, you can have bad executives that run it into the ground. So there's lots of different business risks associated with each business that we invest in. There's financial risk. There's the risk of the financing of a company drying up, of a CFO mismanaging, the financial management of the company. There's market risk just associated with the whims of your average investor buying up or down as far as the stock market is concerned. So sometimes, and the first part of this year in January is a great example of this, the stock market went down by about 12% in the month of January. And a lot of that just had to do with people's fear about what was going on in China. Okay. And you might say, well, why are we worried about what's going on in China? Well, China is a very big market, of course. They buy a lot of goods and services from US-based companies. And we were concerned that if China fell off the map, and really went into serious recession, and they were really struggling at the first year, that if they would have gone into a serious recession, obviously that's going to hurt our market. But that was short-lived, and we recovered those losses within a few months at the first part of this year. But the market can move wildly, can move up and down significantly at any given point. And Frida, you lived through it. I mean, 2008, having MasterCard was probably pretty painful to watch, right? Watching your value go down significantly during 2008 and 9 during the crash. And then, of course, it's exciting and exhilarating when it does the opposite, when it goes up and does well for us. Purchasing power risk is the risk of being able to not purchase the same amount we can today, tomorrow. So basically, this is where inflation comes in. If you have $1 today, right, and it's only worth $1.01 in 1 year, but inflation's gone up by 3%, then you've lost money, right? Because you can purchase less in a year than you could today. So purchasing power risk, there are a lot of different investments that have a lot of purchasing power risk, but the worst ones are things like savings accounts, savings and money markets and CDs right now where rates are really, really bad. Okay, so bank type accounts or cash, both of which have significant purchasing power risk, because it's almost guaranteed that you'll have less power with your money as time goes on because of the effect of inflation. You have interest rate risk. Right now we have substantial interest rate risk, right? Interest rates at all-time lows. Interest rates can do nothing at this point but either stay stagnant or go up. And if you're an investor in bonds, bonds tend to go down in value when interest rates go up. Okay, so that's just a general rule, and it holds true every single time interest rates go up. But when interest rates go up, bonds go down. So if you hold it bonds, you have interest rate risk. Okay, you have liquidity risk. You have the risk of going to sell whatever product you're investing in and not be able to sell it and get your cash fast. So that's a risk that you've always got to keep in mind. You've got different event-driven risk, like acts of terrorism. 9/11 kind of triggered an addition to the dot-com bubble, that had already happened in 2000. Then we got to 2001 and got hammered by the fact that we had, 9/11. And that recession continued from about 2000 to 2002. So it was a 3-year malaise, that the market went down and really struggled. But different events can do that. War definitely, and issues of disease and war tend to be the most significant drivers of where the market goes and how investments do. Okay, so those are all different risks to consider every time we invest. And we could talk about a few additional risks. One of the things I always talk to clients about is we have all those risks that I just mentioned, and then you also have a risk that really can derail us with our investing, and that's just fluctuation risk, right? When I invest someone into a diversified portfolio, there's very little risk. There's almost zero risk to that portfolio going to zero, right? It's not going to default because we've got thousands of positions inside of this portfolio. However, it's very likely that the portfolio will fluctuate in value both up and down. And a lot of people are great about the ups and really stress out about the downs, right? And if you stress out about the downs and you let your emotions get control of you and you sell out, that's a substantial risk to you as an investor, to allow your emotions to control, logic, and for you to sell out when things go down, like we talked about earlier, Frida, with the example of 2008. Most people, and this is just based on looking at the numbers, a lot of people sold out in 2008 and 9 after they had lost 30, 40, 50% of their money, which sounds crazy in hindsight, but that's what actually happened. All right, so returns from investing, we've got a couple different components. We've got income, and then we've got gains. So income is the interest or dividends we receive, sometimes monthly, sometimes quarterly, sometimes annually. Sometimes we don't receive income on different types of investments. And then capital gains is the actual growth or value of the entity going up or down. So just to put it in an example, if I own Apple stock, I own a stock that's worth about $115 a share or so, give or take a few bucks. And the value of my shares, might be 115 today, but they might be 117 tomorrow. So they might go up a few dollars. On top of that, quarterly, I receive about a 2.5% or 2.33% dividend, meaning the shares could stay exactly the same, right? They could stay at $115 a share, but I'm still going to make 2.5% or so on my money because of the dividend. And it's the dividend or income plus the capital gains that gives you your total return on your investment. So make sure you are always integrating both the value change, which is that capital gain component, and the income piece, which is your dividends in the case of stocks, and adding those together for purposes of calculating a total return. So 8% return on a bond after 20 years versus a 5% return. So over a 20-year period of time, pretty substantial. The difference between $2,600 from 1,000 originally up to 4,700 on a bond, right? So you can see that over a 20-year period of time, you've almost gotten 5 times what you started with if you can average an 8% return. If you're only averaging a 5% return, you'll double your money plus some. And this goes to a rule that we always talk about when it comes to investing, which is called the rule of 72. And all you do is take the return that you expect, okay, and divide it by 72, and that will give you how many years it will take to double your money. So if I expect to get a 10% return on my investments, it will take 7.2 years to double my money, because 7.2 times 10 is 72. And that's just a quick, easy way in your head, as long as math doesn't scare you, the simple math, right? But it's a quick, easy way in your head to calculate how long it will take for you to double your money. An easy example of this is if I get 1% from my bank savings account or my bank CD right now, what times 1 equals 72? Well, 72, right? 1 times 72 equals 72. So how many years will it take me to double my money in a bank account at 1%? It will take me 72 years to double my money. And if I can get an 8% return from the market, it'll only take me 9 years to double my money. So you can see the power of this interest component and the power of the difference between getting an 8% or a 9% return versus getting 0.5% or 1% in a bank account. Okay? And that's not with respect to any risk, right? We know that the market is going to give us a lot more risk than a bank account. There's always what we refer to as a risk-return trade-off. In any good investment, there's always, that where information is readily available, you're going to have a risk-return trade-off where if you take more risk, you should get more return. However, there are exceptions to this. There are products that have a significant amount of risk and don't have much return potential. And then there are products that have decent returns and don't have a lot of risk. But those are the exception, they're not the rule, right? Generally speaking, when it comes to investing, especially with publicly traded stocks or mutual funds or bonds, entities that we have a lot of information about, the more risk you take with those types of entities, the more reward you should accomplish. Entities that don't have a lot of information about them, for example, your brother's, mother's, sister's company, right? And they're asking you for investment to help them out with their little donut shop on the corner. That's not public information for the rest of the world to see, okay? And it might have a very high return, and it might not be very risky because that person might be, a person of high integrity, and even if their business goes bad, they might still make good on their money, on your investment. So, and it could also be the flip side, right? There might actually not be any potential with that donut shop at all, and just because you're related through, a bunch of different ways, you might be willing to give to that, even though from a risk-return trade-off, it's not very good. Might be high risk, low return, depending on the situation. Okay? So the exceptions to this risk-return trade-off really have to do with lower, information investing options. High information investing options will usually always follow this risk-return mantra. And whenever we're pitched something as far as an opportunity to invest, one of the first things we always need to be careful about is to obviously think through the risks associated with it, right? Don't just focus on the return potential, but make sure you focus on the risks. One of the things that I spent a lot of time today doing at my work was evaluating for a client an opportunity that they've been pitched by another investment firm on $20 million, okay? So this gentleman is lucky enough to have $20 million. He just sold a business. We'd all like to be in his shoes, right? And he is investing, or at least considering to invest, in 3 different investments that a company has been pitching him. And when I asked him about the details of it, he could tell me all the potential advantages of this investment. But when I asked him about the risks associated with it, it was evident very quickly that he had not considered any of the risks associated with this investment opportunity. And it became my responsibility as an advisor to start going over the risk. And that's kind of a buzzkill, right? We got to go over the negative side. But before you drop that kind of money, before you drop any kind of hard-earned money, and it might be $5, right? Before you go and waste $5 on an investment that doesn't make any sense, Let's think through the risks and let's make sure we've addressed them and that we know what our risk return trade-off is for what we're doing. Okay, so that's the whole point of the exercise of evaluating risks and returns and making sure we're on top of that before we invest. Most people could avoid the Ponzi schemes and the shysters and the shady guys that are doing investment, stuff that they shouldn't, if people would take a step back and really evaluate the risks associated with what they were doing. But most times they don't take a step back, they don't take a deep breath, they allow themselves to get emotionally excited about a potential return that really has the potential to blow up on them, right? Because it's not legitimate, it's not a legitimate investment, but they really hope it's true, right? It's kind of like Bernie, Madoff, right? Bernie Madoff was a master at pitching a consistent high return on his investments. And people never wanted to poke into the details of it, or even if they did, they weren't sophisticated enough to see through some of the details of it in order to question how Bernie was making those types of returns in bad markets. We just hope it's true. We want it to be true. We expect people to be honest. And sometimes that is to our detriment, right? So one of the things that can protect us, though, is to back up, take a deep breath, take our time. Don't ever get pressured into anything. If you feel pressure, back away. But the idea is take a deep breath and really consider the risks associated with what you're looking at, okay? All right, there's a soapbox. All right, Frida, have you ever seen a graphic like the one we're looking at here where it kind of graphically shows the expected return versus the risk that you're taking for different types of investments? Is this ever something you've looked at before? Or is it too small to even tell what's going on here? Okay, so people might disagree like where on the spectrum, different investments would be. For example, I've got a lot of people who think that precious metals are the safest thing in the world, right? And I've got a lot of people who think real estate is so safe, it's much safer than anything else. And depending on how you invest in these different categories, it could be safer, right? But as a general rule, and this is a generalization, it's just lumping everything into the same category, U.S. Treasury bills are considered the lowest risk, and that's in turn why they pay the least amount of interest among these different options. Long-term bonds are considered a little bit riskier, still very low risk, and they're considered, and your ability to get interest is a little bit higher. Then you get to common stock, real estate options, commodities, and precious metals, and of course, the risk-return trade-off should increase. One of the things that I had to address with a lot of people about a year ago, a lot of different customers would come in and talk about gold and silver, right? They wanted to invest in gold and silver. Well, gold was at about $2,000 an ounce, and I'm telling people, hey, gold has a high risk reward trade-off, right, when it goes through these cycles. And gold has gone, just in the past little while, from $350, $400 an ounce up to $2,000, so almost 5 times its value in the last 3 or 4 years. That kind of cycle means to me that there's a high risk to the reward associated with this investment when it's really high in its cycle, right? And so it's just one of those things you have to just look at and make sure you understand the risk of those cycles before you get in, because there's a potential when things are up really high, obviously, for them to come back down. And that's exactly what happened in gold. Gold is now at about $1,300 an ounce, which is still higher than what it was, 5-6 years ago, right? So a long-term investor in gold's done okay, but a short-term investor in gold has gotten hammered. They're down 35-40% on an investment that they thought was supposed to be really safe. Okay, so just something to think through, and there's a reason that this chart is built like this, because history would show that these different items, have this kind of risk profile associated with them. They're not just making it up or taking a best guess or giving you their opinion. This is what history would show is the risk reward trade-off for these different items. As like I say, once again, don't read too much into the specifics, because the specifics, the devil's in the details, right? There are common stocks that are much more aggressive than others, and there's real estate that's much more aggressive or much more volatile than other types of real estate. So it's just one of those things that you got to dig down a little further and really see where things are at. But just keep in mind that's a generally accurate pendulum as far as the risk that you're taking, the reward that you should expect. So good investment, of course, has a future return. If we didn't think we were going to get a return, then going back to that total return, it's either a value increase or income, or both, right? Or a combination of both. When we talk about blue chip stocks, we're talking about stocks of very large companies that both give us a dividend, they pay us for owning them, and they also should go up in value over time. Okay, when we talk about the S&P 500, we're talking about 501 of the largest stocks in the United States. Of those 501 stocks, most of them pay dividends. And if you look back historically over the past 60 years and you look at an average total return for the S&P 500, okay, you might get a number like 9%, 3.5% of which is dividends. Okay, a big chunk, over a third of the total return associated with the S&P 500 over the last 50, 60, 70, 80 years, okay, depending on which grouping you look at, but over the long term, a big chunk of it is dividends, okay? So if you own a growth stock, you have more pressure to make sure that your value increases because a lot of growth stocks don't have any dividends. If you have a dividend stock, you don't have as much pressure for your value to go up because you're going to get paid just to own it. So a lot of people like dividend paying stocks because they feel like they're at least making progress even if the stock market doesn't, okay? Even if the stock doesn't go. All right, here's some calculation numbers. Investing in common stock, we talked a little bit about this. Each share represents equity ownership, like we talked about. Stock ownership is a residual. Why is it residual? What does that even mean? It just means that a firm, if it's struggling, its obligation is to pay its debt holders first. Okay, it's bond holders and it's debt holders. Then if there's anything left, they pay stockholders. So just a quick example of this, GM in 2010 got bailed out, right? General Motors got bailed out by our federal government because for all intents and purposes, General Motors was bankrupt at that point. So it was either let General Motors, this huge employer, this legacy company, huge company here in the United States, fail, right? Or federal government could step in, give them billions of dollars and bail them out. Well, part of the government bailout that happened in 2010 for General Motors was a restructuring program that meant that all common stockholders, so if you own stock in GM at that time, your value went to zero, okay, which is similar to what happens in a bankruptcy for a company. So years ago when Delta Airlines went bankrupt, okay, and restructured, all common equity holders, all stockholders went to zero. Okay, you have nothing. And then after they go through the restructure, they reissue new stock to new shareholders, and that's why the stock still exists. So, for example, if you look at a chart of GM, today, the stock chart looks pretty good over the past 5-6 years. The stock has done pretty well. But if you look back 10 years, okay, there's not more than 10 years of history, or if there is on the chart that you're looking at, it's not accurate. Because what happened in 2010, like I said, is that every stockholder to that point went to zero, it restarted, and it's new shares that we're trading nowadays for the last 6 years. Okay? So a risk of investing in stock is that a company can restructure, start over, the company still exists, but the stockholders get blown up. Okay? Not to mention you have a lot of stocks that just go bankrupt anyway because they're not well run, right? They're mismanaged, or they have financial problems, or they have selling problems, and so they end up going bankrupt. So just a risk associated with common stock that's always important to consider is that you're a residual owner as a stockholder, which means that you're last on the totem pole when the court comes in to shut down the business, right, and restructure it. Bondholders might get paid back, okay, but stockholders, it's very unlikely that they'll get anything. Okay. All right, on that negative note, let's keep going. Here's a chart that doesn't go, it's not very current, but it goes through 2012 and basically shows you the ups and downs of the Dow Jones and the NASDAQ. The NASDAQ is the dark line, it looks like. The Dow Jones is the lighter line. And you can see that generally they follow each other, right? Similar patterns, like in 2008, they both got crushed. And the NASDAQ and the Dow Jones and the S&P 500, if we were to write the S&P over this on another chart, you would see that they follow each other as well. So when on the radio or on TV, they talk about the Dow Jones or the S&P 500 moving up or down that day, it's because investors like to hear, based on these indexes, how their stocks probably did that day without having to look at them. Right? Instead of having to look at my accounts every night, which I could if I wanted to, but instead of having to log in and look at them every night, if I know basically what the market did that day, I'm going to be able to extrapolate or figure out for myself what my accounts probably did as well. So if the market goes up 1 or 2%, if I'm in a moderate to aggressive account, my accounts probably went up by 1 to 2% as well. Okay, or at least went up. How much they went up is dependent on what I'm invested in. But that's why they always talk about the Dow, the S&P, the NASDAQ every day on the news, on the radio, online, because that is an indication of how the market is moving, what the market is doing. As a common stockholder, you have some privileges. You get to vote. You get to vote for the board of directors, which in turn are the folks who control the executives. So large public companies will have a board of directors that are voted in and maintained by the shareholders, right? You get to vote for the shareholders, or excuse me, for the board of directors. And then the board of directors are the ones that control who is actually running the day-to-day operations of the company. The CEO, the COO, CIO, CFO, all those are controlled by the board of directors. Okay, so it's kind of a checks and balances system. You and I as individual owners don't really have any control at all. We vote in folks to represent us. Those are the board of directors, and those board of directors are the ones that make decisions on who leads the company, and then those leaders of the company are the ones that make the day-to-day decisions of the company. Okay? I don't know if that was confusing enough, Frida, but basically that's the hierarchy of how a publicly traded company works, a big stock company. So when you own MasterCard, right, you had the ability to vote or ratify board of directors for MasterCard. Of course, you might have had just a handful of votes and there's millions of votes, so you may have felt like it wasn't very impactful. But the more shares you have, the more votes you get, and the more votes you get, the more impactful that voting is, of course. Okay. Tax considerations, we're not going to look at that. I think we need to go to the next set of slides real quick. And we're not going to have a lot of time in this next set of slides, but we'll at least have an ability to kind of introduce the concepts. Let me full screen this one. Let me share the new one. Okay. Frida, are you seeing number 13, investing in mutual funds, exchange traded funds, and real estate? Okay, thank you. All right, just some basics about mutual funds and exchange traded funds, which by the way are very similar products. Okay, both of them are managed by financial institutions that are trying to diversify and help individuals invest in a diversified way, right? So if I have $100, I can't go buy 1,000 stocks with $100, right? But if I have $100, I can buy a mutual fund or an ETF that owns 1,000 companies. Okay, so it's from an economies of scale standpoint, it's a very cost-effective way of investing in a lot of different things with a smaller amount of money. Okay, if I had $1 million, I can invest in 1,000 stocks, and that's fine. But if I have even $1,000 or $100,000, it might be better for me to invest in mutual funds to become more diversified than I could off buying individual stocks. Plus, if I buy a bunch of individual stocks, I have transactional fees with each one, right? I have to buy and sell, and each time I buy and sell, there's a transactional cost. When I buy a mutual fund, I have a percentage cost on an annual basis. Okay, it's fee associated with the account. Okay, and that fee might be like 1%. Well, 1% on $1,000 is $10, right? So to have a mutual fund that charges me 1% and have $1,000 in it, I get professional management, a high level of diversification, okay, which lowers my risk, and all those positions without any transactional charges for $10. That is a significant economy of scale or value add, and reason why exchange traded funds and mutual funds are so popular is because they allow someone who's putting smaller amounts in, like in a 401k or IRA. Mutual funds and ETFs are very easy to use. They're professionally managed, they're highly diversified, and they allow me to get in at a very low cost, right? But then over time, if I were to hold, say, for example, a stock like MasterCard for 5 or 10 or 15 years, it would be less expensive for me to be a long-term stockholder than it would for me to be a long-term mutual fund holder. It's just that in mutual funds, I'd be more diversified and professionally managed than I am in that individual stock. Okay, so there are pros and cons of both, but the reason that mutual funds and ETFs are so successful, and there are so many investors in mutual funds and ETFs, is it allows us to have professional management, diversification, and economies of scale from a cost standpoint for our investing. So pool diversification is a key concept of mutual funds and ETFs. You pool investor money to diversify, so if I'm a mutual fund company, I'm taking all these different investors' money and I'm pooling it together to invest broadly across a lot of different investments for all of them, okay? Where those individuals probably couldn't be as diversified if they tried to do it on their own. Here's graphically what it looks like. Why do we do it? Just what I said: diversification, professional management, convenience, economies of scale like we talked about, and financial returns. In the end, professionally managed mutual fund on average, okay, if you take like Growth Fund of America that's been around for like 80 years, its average rate of return is better than the market and better than the average statistically speaking, better than the average investor accomplished over that same period. Doesn't mean that there are a bunch of investors that didn't do a lot better, right? It just means that on average, it's a good and fine opportunity for investing, and it takes less effort and homework than individual stocks do. Okay, here's the idea. How do we price a mutual fund? We just take all the price of all the assets inside of the mutual fund, other different stocks or bonds or both. We obviously minus out any liabilities and divide it by how many shares are out there, how many shares have been created as far as that mutual fund is concerned. That's what gets us to the NAV, or the net asset value, or the share price. Another way of saying is share price of a mutual fund. Okay. By the way, the most common product in a 401k or IRA is a mutual fund. So the average brokerage account, will have more stock and ETFs and other things, but the average IRA or 401k in the United States, at least for retirement planning purposes, is usually filled with different mutual funds. Now that's changing a little bit because a lot more companies are offering ETFs in their portfolios, but still to this day, mutual funds dominate retirement plans. Exchange traded funds, a little bit different. Okay, usually they're more like an index mutual fund, low fees, usually computer generated management, and usually tracking an index, and low cost. So anyway, there are different fees and costs associated with mutual funds. It's important for you to understand that. It's also important for you to understand how you can research different returns just like you can on stocks. It's all public information. Any of the information about fees, about returns, all has to be public when it comes to these different funds and when it comes to publicly traded stocks. So doing your research doesn't have to be a phone call to a stockbroker, right? Like it used to be. A lot of people used to call a stockbroker to get information on different positions and ideas. Nowadays, for free, you've got access to any information you'd like to know about a publicly traded company or stock or mutual fund. As far as returns, financials, all those kinds of things, it's all public information. So you can kind of start and do your own research if you'd like, and end up investing on your own if you'd really like to, or just use that information to be more educated as a consumer when you go to employ an advisor in getting investment help. Okay. All right. So you got all kinds of different types of mutual funds. You've got growth funds, of course, that are more aggressive. You've got aggressive growth funds that have more risk, right? If I were to say line these up based on the risk-reward spectrum, of course, aggressive growth would probably be in the top right? Higher return potential, higher risk. And something like a value stock would be in the lower right as far as stocks are concerned, and mutual funds, because that would be a mutual fund that's more focused on dividends and value creation over time as opposed to growth or aggressive growth. Okay, balanced is a mix between value and growth. You've got growth and income funds, you've got bond funds, money market funds, which are basically like a cash savings account. You've got indexes, different sectors, like you might have consumer staples, which is one that would have like companies like Procter & Gamble and Johnson & Johnson, or you might have companies like consumer discretionary, which is a different sector that focuses on companies more like Carnival Cruises and Harley Davidson. So consumer discretion are products and services that benefit when people have discretionary money to use, right? Extra money. And consumer staples are products that benefit when we use the daily products that we all use already, like toilet paper and toothpaste. Okay. And you've got something that's called a socially responsible, or SRI type of fund, socially responsible investing. Those SRI funds are basically focused on different types of socially responsible things. So for example, it could just be sustainability that they're focused on, or it could be making sure to avoid tobacco and alcohol, or gambling, or nuclear power. There's all kinds of different ways to be socially responsible with investing. But if that's something that appeals to an investor, they should look into it. There's lots of options. Okay, that's all I've got time for as far as the introduction on mutual funds and ETFs, and we didn't get to the final component of this particular chapter, which is real estate, so you'll want to just review that briefly before you get to the test. But Frida, unless there's any questions, let's take a few minutes and cover what we need to know for the test. So for the 10 questions on the test. Any questions before we do that? Okay, well then let's do it. Okay, so when we talk about the test this week, as I mentioned before, 10 questions, 5 points apiece. Looks like they are all multiple choice. Nice. Not even any true false questions this week, it looks like. Let me just double check that. Yep, all multiple choice. Okay, so number one on the test, you want to be able to understand how to calculate the total return of an investment, right? How do you calculate the total return on investment? What you do is you take the dividends associated with it plus the gain. Okay, so dividends plus the gain, and you then add that to the original investment amount. Okay, and you divide it by the original investment amount, and that's your return for the period. Okay, so you want to be able to calculate a real basic answer, right? So no, basic problem. They're going to give you the numbers. You're just going to plug them in. They're very easy numbers to plug in. You're not going to know, these aren't going to be huge, hard, numbers, but you do need to know basically how you would calculate a return for an investment. Okay. You'll want to know about PE ratios on stocks, which are price earning ratios. Just know what the book has to say about price earning ratios being higher or lower, and what does that mean? Okay, what does it mean when PEs are high? What does it mean when PE ratios are low? What does the book have to say about those two things? Number 3 on the test. Number 3 on the test is just a really simple math problem associated with earnings per share and a price per earnings ratio, which is the PE ratio that we talked about. So if you know how to calculate a PE ratio, you'll get number 3 right on the test. Just what is the formula for PE? Well, it's price over earnings per share. Okay, so if you know earnings per share and you know the price, then you can figure out the PE ratio, and you can figure out each one of those components if you've got 2 out of the 3, right? So if you know the formula, you can plug in the 2 numbers that they give you on number 3 on the test and get that problem right. Number 4 on the test, we'll want to know what the price does to a yield. What do I mean by that? Well, we talked about how there's 2 components, right? There's income and then there's value change. When an investment goes up in value, the yield, the effective yield on that investment has to go down. When the value of an investment goes down, the effective yield has to go up. Why? Because they're paying the same dividend, right? But if a price is higher, that means the effective yield of that dividend has got to be lower. So they just work inverse of one another. So if price goes up, yield goes down. If price goes down, yield goes up. Okay. Number 5 on the test, you want to know the difference between business risk, economic risk, market risk, those different risks that we looked at. You want to know an example of and be able to define what event risk is. We alluded to it. Active war, for example, is an event risk. But you want to know what else the book has to say about different event examples. Let's see. You want to be able to define business risk. I think we already did that, so that might be kind of a repeat. Yeah, you want to be able to define business risk so that you can get number 7 right. Number 8, you want to understand the different components, which we didn't get to this slide and really go over it very well, but there are different aspects of a fund company or a money manager, like what the different players, I guess you could say, or different components or people involved in a mutual fund company are. You've got different names and different roles, and you'll want to understand what those different roles are within a mutual fund company, so you'll get number 8 right. Number 9, just make sure you understand fees on mutual funds, the different names for the different types of fees on a mutual fund, loads, no loads, 12B1s, what are those? and you'll get number 9 right on the test. Number 10 on the test, you'll just want to understand the basics of why. So basically the pros and cons of a mutual fund. Okay. Why do people invest in mutual funds? We talked about them. They'll list it off, the different reasons that people invest in mutual funds a couple times, but you want to just have a working knowledge of those. You don't have to memorize them, but just be able to identify them, and you'll get number 10 right on the test. Okay. All right, that's your test. Not too hard, pretty straightforward, only 50 points, only 10 problems. Should only take you about 20 minutes if you've read through the chapters. And if you've got a note on what the topics are, Frida, you're going to be in great shape. Shouldn't be anything tricky, but as always, read and reread through the assessment questions so that we don't get anything wrong. One of the things that I didn't mention tonight that I should have mentioned at the very beginning of the class is, of course, the school has no allowance, okay, for plagiarism. So, of course, we don't use somebody's paper from online, and we have systems to catch that, so don't try to do that. But one of the things I find that's very common in a class like this is for people to cut and paste onto the discussion board. And I should have mentioned this, like I say, on the expectations at the very beginning, but please don't cut and paste on the discussion board. The discussion board is a place where I want your feedback and opinions. I want your feedback and opinions, not what you find online. You can refer to that secondarily, but primarily, I want your feedback, your writing, your unique take or opinion on what we're talking about. So just keep that in mind for the discussion boards so that we can have a good, clean discussion board and get a lot out of it. Okay. Frida, any questions before we wrap up tonight? Thanks again for being here. I sure appreciate that. Okay. Have a great week. If you get stuck on anything, let me know. And we'll hopefully see you next week. Thanks, Frida.